Hello, everyone. A very good afternoon. Hi, how are all of you doing today? Warm welcome to everyone who's here. Today we have another masterclass for all of you and a very, very interesting topic lined up. So, welcome, guys. We're just going to wait for 2-3 minutes because we're just waiting for some more people to log in. So, please bear with us. Hi, Jitendra. Hello, Mr. Kapoor. Hello, Ravi Ranjan. Welcome. I would just request all of you to just give me a hi on chat so that I know how many of you have joined and who all is there. I've realized that, a lot of times I have a lot of people who've been attending my master classes for a really long time. So I see a lot of familiar names. Hello, DVC. Hi, Kushal. Um, hello, Balakumar. Uma Shankar. Irshad. Hello. Uh, okay, so guys, this session is going to be in English. हमने लास्ट वीक वाला सेशन हिंदी में किया था, तो आज हम ये सेशन इंग्लिश में करेंगे, बट आई प्रॉब्ली डू अ कॉम्बिनेशन ऑफ हिंदी एंड इंग्लिश. ठीक है, आई अंडरस्टैंड कि हमारे कुछ ऑडियंस हैं जिनको हिंदी पसंद है, कुछ ऑडियंस जो इंग्लिश में बोलते हैं. अब ऑब्वियसली वी कैन नॉट डू द सेम सेशन इन बोथ द लैंग्वेजेस, सो I'll try to do a combination of both. Okay. Hi Divyansh. Hello Nitin. Hi Ganesh. Good afternoon. Hello, Rahul. Yes, a very happy Friendships Day to all of you. Thank you so much. And a very happy Friendships Day to all of you guys. Rahul, hello. Hi, Manju. Durga Prasad, Ratish, Ruchi. Yes, Dr. Prabodh. Hello, welcome. Divyansh, hi. Lubna, Nitin, Bhavna, Bhavan. Okay. I have Sur, such a beautiful name, Sur. Akshay. And I have Singh, I have Babu, Mandeep. Okay, I have so many of you on the call. But guys, thank you, Akshay. Yes, glad you're joining my session again. We're just going to wait for 2-3 minutes, guys, before we start. I hope that's okay because we're just waiting for some more people to join. And I truly, truly hope that's fine with all of you. And thank you so much for joining on time. Yes, thank you, Srinivas. We're always glad to be doing this for all of you, right? I mean, I've been doing these masterclass for over a year now, and I'm always so happy to be doing this masterclass for all of you. So thank you so much for joining. Thank you, Durga Prasad. Hi, Rahul. Okay. Okay. Hi, Lubna. You're from Dubai. Welcome. Thank you so much for joining. Thank you. Thank you, Nitin. Glad to know that you enjoy my sessions. डीवीसी तो मैं ट्राई करूंगी हिंदी और इंग्लिश दोनों में बोलने के लिए. ये सेशन लेकिन मोस्टली इंग्लिश में रहेगा. दिस सेशन मोस्टली वुड बी इन इंग्लिश. आई होप दैट्स ओके. Krishna, Praveen, Ashish, hi. Just another minute and we will start. Aj, I'm sure all of you know what we're going to be discussing, right? It's an amazing topic. Today we're going to be discussing about multi-bagger stocks, how to identify them. But I'm sure you guys agree that it's not easy to identify a multi-bagger stock. I'm going to give you my few tips on how I go about doing it. Have I been able to identify multi-baggers? Maybe to some extent. And that's the reason I'm just going to help you understand what are some of the ways that you could look at identifying multi-bagger stocks. Okay. So great. So let's get started. And yes, hello Rajesh. Thank you so much. Mr. Bangaram, I cannot talk in Telugu. Hindi and English are the only two languages that I can communicate in. So yeah. Okay, so let me quickly introduce myself. My name is Namrata Arora, and as all of you might know, I've been working with Groww for a really long time now. We've been doing a lot of content creation work with Groww. And we do this masterclass concept we've been doing for over a year now, where we try to pick a topic and we try to explain that in detail. So next 1 hour I'm going to explain in detail about the topic that we have chosen. Yes, and if you guys have any questions, which I'm sure you will, you can put it on the chat. And what I will do is at the end of the session, I've left about 10 minutes where I'll take all your questions. Okay. So let's get started. And once again, like I said, thank you so much for joining and a very happy Friendships Day to all of you. I'm getting so many messages, so thank you so much for that, Atul. Thank you. Okay. So let me just start off by quickly sharing my screen first. Just give me a moment. I'm guessing all of you can see my screen. Yes? Okay. Perfect. Yes. Okay. So let me start off by telling you quickly about what exactly are multi-bagger stocks, right? So I'm sure a lot of you would want to understand what are these multi-bagger stocks. Yes. So when we are talking about multi-baggers in general, I think one of the most common reasons for new investors specifically, right? Now, if they entering the equity market, if they want to invest in equity, a lot of times investors are looking at wealth creation. That's one of the main reasons why all of us look at equity, right? We want to invest in equity because we want to create that wealth that that a lot of people around us have probably created by investing in stocks. Who doesn't want to get rich by investing in stocks, especially if we can identify a good multi-bagger stock? Nothing like it, right? I mean, we've heard of so many examples. So, there's this person, the legendary Peter Lynch, he coined the term 10 baggers. Okay, so 10 baggers was basically for those stocks that multiplied the investor's money 10 times. Okay, so that was 10 bagger. But today, I think we have seen stocks which have 100 baggers, right? And that is how the whole term called multi-bagger came into existence, isn't it? So the whole logic of multi-bagger is basically a stock that can give us multiple time returns, right? And that is what I think all of us eventually want from our investments. So which is what we are going to be looking at. So just a minute. Yeah. Are all of you able to see my screen? Just a minute. Yeah. Just give me a moment, guys. I think a lot of you are not able to see my screen. Okay, just a minute. Let me just... Okay, just give me one moment. I'm going to share my screen again. Yeah. Yeah, okay, so just hold on. I'm just trying to share my screen. That is one of the reasons why I'm not able to. Yes. Tab. Okay. Yes. Okay. Okay. So. Okay. So let's get started. And when we're looking at a growing economy like India, I'm sure India as an economy provides us a lot of opportunities. Yes, I mean, in any growing economy, you have the potential to look at those companies which have the potential to give us those multi-bagger returns. Some of the 100 baggers, right, for all of us includes companies like, say, Infosys, Wipro, Asian Paints, Motherson Sumi. These are some of those companies which have given multi-bagger returns from, and they belong to different sectors, right? In fact, I think if you see BSE, Bombay Stock Exchange, that is a multi-bagger in itself, right? It's touched the 100-bagger mark for the first time in Feb 2006. So in Feb 2006 was the first time that Bombay Stock Exchange touched the multi-bagger mark, okay? So when it started, right, in 1979, which was at 100 rupees, right? That's where BSE started. And BSE Sensex in March 2022 was at 58,568. So it touched like the 600 bagger mark at that time, 600 bagger mark in March 2022. And two of the most recent multi-bagger stories in the last 6 months would be, say, Chennai Petroleum Corporation and GMDC, which is Gujarat Mineral Development Corporation, right? So these are some of the examples of companies which have given multi-bagger returns. Now, one thing that I want to tell all of you is please don't take any of these names that I'm taking as our recommendation or as our advice. These are truly just to show you how companies and which are the companies that have given good returns and stuff like that, but they're just as an example to explain the concepts, right? So on the screen, what you see are those multi-bagger stocks. Yes. So for example, Wipro, Infi, Ranbaxy, Cipla, Aisha, all of them, if you see over so many years, have given multi-bagger returns. Like Infi in 28 years, had you invested 10,000 rupees 28 years back, it would have become, say, 14.56 crores. Wipro, had you invested in Wipro in 1980, which is about 41 years back, it would be 806 crores today, right? Same logic applies to Ranbaxy, Cipla, and Aisha. I mean, of course, Wipro is an exception in terms of the kind of returns that it has given, but there are so many companies that have given these kind of crazy returns. But the challenge is, how many investors have we seen which have actually made this kind of money? Because the challenge that we face is that, a lot of times as investors, we don't have the patience to stay invested to see these kind of returns. Yeah. Long-term investing from an equity point of view is one of those most important aspects that helps us in getting those multi-bagger returns. We have seen these examples, but there'll be very few people who experience this kind of wealth creation because people don't have the patience. Okay, so step number one, rule number one, you have to have the patience. If you think you have identified the right stock for yourself, which has the potential to become a multi-bagger, you have to give it time. And we're going to keep discussing about what are the aspects that we should look at to identify those multi-bagger stocks. Okay, so moving on. Now let's understand that what are some of those features that we should look at while we are investing or while we look at these multi-bagger stocks, right? So what are some of those key points or those basic features that we should keep in mind? So point number one, clearly that these are basically companies which are financially really strong and have very strong management team, right? And their business models are developed in such a way that the businesses can be scaled up in very short periods of time. So I'm going to give you examples to explain this, right? But I'm just giving you those basic features that you should keep in mind. Companies which are financially strong with very good management team, but ideally having business models which can be scaled up really fast. Okay, that is super important. Then extended consistent growth. Now what defines a multi-bagger is truly this: these are such companies which have very, very promising future, and they show continuous growth over long periods of time, right? So these are the companies that are not showing growth over a particular period of time and then they don't show any growth, then they show growth again. It has to be consistent over a long period of time. That is super important. Okay, then we look at companies which have very strong fundamentals and on an average take 10 to 15 years to become multi-baggers. Okay, now why I'm saying this is because if suppose you have invested in a particular company or a stock which which gives you 60 to 70% return, say in a year's time, that probably is just out of speculation, right? Probably just there's some some outlier event that has happened, right? But ideally you look for those companies which on an average take 10 to 15 years. A multi-bagger can never be created in 1 year. If a company giving multi-bagger returns in a year is not one of those companies that you look for. They're probably good for short term, but ideally you look for those companies with strong fundamentals which take some time to give those multi-bagger returns. Okay, now a lot of times what happens is many investors make this mistake. They keep tracking their portfolio and they keep analyzing and screening stocks in the large cap space. So a lot of times we are looking for multi-bagger stocks in the large cap space. I'm sure all of you agree that when we look for multi-baggers, we look only in the large cap space. But what you have to understand is that most of the multi-baggers actually come from the small and the mid cap segment. So these are basically companies which eventually get into the large cap space. So when they've already grown, they are in the large cap space. But if you want to identify a multi-bagger, you should ideally look for small and mid cap segment. Okay, because historically we have seen that maximum number of multi-baggers have come from small and mid cap segment. So it is important that you keep a lookout in the small and mid cap segment as well, and don't keep churning into the large cap segment, because they would eventually become large caps if they are multi-baggers, correct? But if you want to identify them young at an early stage, then it has to be mid cap and the small cap segment. Okay, then of course you look for certain basic numbers, right? Whenever you are looking at companies, you look at certain basic numbers. So for example, you look for their revenue, their EBITDA, and these, they can very easily give you a very nice picture about the company, about the true metal of the company, right? So basically the operating performance is a pointer to its valuations. And if the valuation multiples are low and the company is doing very good in terms of earnings, then we are in for a good ride. Then that's the company that we should be looking out for. So we're going to discuss about numbers in detail, of course, as we progress further. That's one of the things that you look for while you're identifying a company, right? So what are some of those basic numbers to look for? Yes. So if I want to identify a multi-bagger stock, what are some of those basic numbers which will help me identifying? Because numbers are one of those critical factors that we look at when we are identifying stocks. Yes. So what are some of those numbers? So first is revenue and EBITDA. So what is revenue? I'm sure all of us understand what is revenue. Revenue is the total income generated by the company by selling all the goods and services. So whatever is the main operation of the company, by selling those goods and services, whatever is the income that they have generated, we call that as revenue. Yes. Now, what is EBITDA? EBITDA is earnings before interest, tax, depreciation, and amortization. And these two aspects talk about companies' short-term operational efficiency. So in the short term, how efficient they are from an operations point of view are these two numbers. Okay. Then you look at, say, ROE, return on equity. And these are numbers we've spoken about in greater detail in our previous master classes. Yeah. So I'm not going to get into in-depth, but I'm going to explain high level what these numbers are. So when we say what is ROE, ROE is nothing but return on equity, which basically tells you what is the return which is earned by the equity shareholders of the company. Yes, higher the ROE generated by the stock. So if the ROE of a particular company is high, it would obviously have a very good impact on the stock price as well, right? If the company is able to generate good returns for the shareholders, it will have a positive impact on the share price. The general understanding is that companies which have high ROE, they are capable of generating cash internally. And that means they're less dependent on debt financing. So if the company's ROE is high, it means that they can manage to run the business on their own without depending too much on debt. And I think that is something that is obviously very important for us. Then you have debt to equity. So this ratio basically gives us a picture of the weight of debt on the company, right? So basically, how much debt a company is holding. And obviously, this ratio, the lower it is, the better it is. Yes. Historically, it is seen that generally the multi-bagger companies tend to have low debt to equity ratios, right? Because if a company has very high debt, then it will be very difficult for it to manage cash internally on its own, which means it is going to have an impact on the share price as well. Okay, so debt to equity, I truly believe, is one of the very, very important parameters or factors that we look for when we are identifying, or when we are trying to identify a multi-bagger stock. Okay, and then of course, PE and PB ratios, valuation ratios become super important in this particular aspect. PE and PB are both valuation ratios, price to earnings ratio, and then we have price to book value. They tell us if the stock is overvalued, undervalued, or fairly valued, right? If these ratios are high, it means the stock is overvalued. Now, obviously, we have to understand that just because it is high, it doesn't mean that we should not invest in it. And just because the PE ratio is low, it doesn't mean that we should invest all our money in that. PE and PB ratios have a separate value in terms of how to identify stocks, and we'll talk about it as we progress further. Okay, so valuation ratios are always looked at after we have understood the fundamental of the company, and only then when we're confused between two stocks and we have to pick between the two stocks and we are totally convinced about those two companies fundamentally, then we look at the PE and PB ratios, and obviously whichever is lower, we take that company. Okay, so I'm going to help you understand in terms of how we can identify stocks. So we call it the four-pronged approach, and that is what I'm going to help you identify. Okay, and I'm going to give you examples to make you understand that if you're looking at identifying super stocks for yourself in your portfolio, then what is it that you should be looking at? So first things first, obviously there is an initial screening. Okay, now see, you have to understand that there are almost 5,000 odd companies which are listed, right? So we have 5,000 odd on the Bombay Stock Exchange, 2,000 odd companies on the National Stock Exchange. Do you think we have time or the expertise to read the financials of all these companies, all the financials? Obviously not, right? So there has to be some form of initial screening. So there are these very simple ratios that you should look at to shortlist stocks on the basis of performance, debt, and earnings and liquidity. So I'm just going to give you those few parameters which will help you in initial screening, and then you get into in-depth after you have screened that which are those stocks that you're going to look at. So these are the few things that you see on the screen are enough for you to do the basic screening of the companies. Okay, and once you have done the basic screening looking at these parameters, then you can go into in-depth based on the shortlisted stocks. Okay, so let's start with certain aspects. So first we'll look at high ROE. So we've just discussed it, return on equity. So a company with high ROE, right? So how do you calculate ROE? It's a very simple formula. Company's net income divided by the shareholders' equity will tell you what is the ROE of a company, and it basically tells us the profitability and efficiency that the company is performing at to generate that profitability which all of us want. If a company is profitable, then I'm going to make money. If the company is not profitable as an investor, I'm not going to make money. So then what should be the ideal ROE? Look at those stocks which have an ROE of more than 15 to 20%. Those are the companies which are a good addition to your initial screening stocks. So initially, if you want to screen your stocks, look for companies with an ROE of more than 15 to 20%. Okay, that's it. You just need to look at that one parameter. Next, we look at debt to equity, right? So then, of course, debt to equity is an important parameter, and the lower it is, the better it is. Agreed? That we've just discussed. Less than 1 debt to equity ratio indicates that the company is very good at allocating capital. Okay, so ideally look for debt to equity ratio of less than 1. So generally what happens is with companies which have low debt to equity ratio, it basically tells us that this company has free cash flows, right? That means the cash flows are relatively freer, and those cash flows can be used to fund future expansion. Now see, a company cannot become a multi-bagger if it is not really investing money for future expansions, right? So you have to look for those companies which have freer cash flows, which can utilize those funds for future expansion and maybe to pay dividends, and thereby it'll eventually lead to incremental ROCE, which is return on capital employed, better than the base year. So what I'm trying to tell you is companies with low or with no debt, they have very high chance of becoming future multi-baggers. But these are companies with low or with no debt at all. Okay, so that is what you have to understand while you are looking at screening your companies. Okay, so low debt to equity ratio is definitely something that you should be looking for. Then you look at these earnings ratios. So these are your 3 or 4 screening things. That's it. You don't need to look at anything beyond this to screen your initial 10 to 15 stocks, right? Now, what is earnings ratio? So there are 3 important ratios that we look at under the earnings ratio. So there's PE, earnings per share, and PEG, okay, which is price earnings to growth. So let's understand this. So PE is price to earnings. All of us know that. So basically look for those companies that have a PE ratio which is less than the industry average. Okay, so if the industry PE is X, the companies that you are trying to look for should have PE ideally less than the industry average. But what we have to understand that everyone is on a hunt for multi-bagger stocks. I'm sure you agree. People are looking for multi-bagger stocks so far all the time. And because if the fundamentals of a company are strong, then the stock will have the high PE as well compared to its peer. I mean, logically speaking, if the fundamentals are strong, if people are looking at investing in that company, then the PE is also going to be high. Yes, so that is why you have to look out for factors because of which the PE is getting affected, right? So if PE is getting affected because of, say, improved profit margin or, say, growth in earnings potential, then those are the companies that you could consider. Yes. So in the initial screening so far, what all we've learned? Initial screening, high ROE, low debt to equity. So high ROE, more than 15 to 20% ROE is a good company to look for. Debt to equity, ideally less than 1. Okay. The lower, the better. Earnings ratio, first you look for PE, ideally look for companies which have less than industry average, but then look for the factors which are affecting the PE, which is very important. Then you look for EPS, which is earnings per share. Yeah. Now, what is this earnings per share? A company can grow the investor's wealth. As an investor, how will my wealth grow? If the company is growing on revenues, profit margins, market share, all these things are growing for a company, that is going to have an impact, a positive impact on the share price, which will have a positive impact on my returns, right? And all these aspects, revenues, profit margin, market share, they are reflected in EPS, okay? The stock price of a company usually mirrors the EPS, and it's a great indicator for a stock's potential in the long run. So, EPS is one of those things that I look for when I'm truly trying to identify a very strong company, because the stock price will generally mirror the EPS, okay? And EPS of multi-baggers are generally on the growth trajectory, if you see. Okay, so look for earnings per share. Earnings per share is a very good indicator of the future potential of the company. Okay, then we have PEG. A lot of times people don't look at PEG, but understand this. When you are trying to identify a multi-bagger, you're looking at future potential. PEG will help you understand the future potential of the company. So growth at reasonable price is what I say. Always look for those stocks don't look at investing only in growth or entirely value kind of stocks. Look for those companies which are a combination of growth and value, and that you can identify through PEG, price to earnings growth. So basically, how do you calculate this? Very simple. You divide the company's current PE, whatever is the company's current PE, by the earnings growth rate. And it is designed to tell you the balance between growth and value. See, so what I'm trying to say is, don't look for only growth companies, don't look for only value companies. Look for those companies which have a balance of both. Okay. Optimal PEG ratio is 1 or less. And that is going to help you by growing stocks without overpaying for it. So ideally, when you're looking for the PEG ratio, look for PEG ratio of less than 1, because that means you are investing in a company which is growing, but it is not overly valued. Okay. PEG of less than 2 is a probable indicator of multi-bagger. Okay. PEG of less than 2, that's what you should be looking for, is a probable indicator of a multi-bagger. Okay. So these are the 4 parameters that you truly should look for. And if you have identified these numbers, you'll be able to at least shortlist some companies for yourself through these 4 or 5 parameters. All these numbers, if you see, are available on the Groww app, right? So whenever you're looking at a stock, these numbers are clearly visible. You just have to look at those numbers, and I've given you the indication in terms of what it should be, and you'll be very easily able to identify at least you'll be able to shortlist stocks based on these numbers. Now, once you have shortlisted these stocks, then what should we do? Right? So I've shortlisted multiple stocks based on these parameters. Now, what is it that I should be doing? So after that, I do 3 things. We'll start with the quantitative analysis, because obviously numbers are going to tell you that is this company good enough or does it have a strong potential, right? So in quantitative analysis, first what we're going to do is we are going to look for those companies which are high growth plus high ROCE. Okay, ROCE basically stands for return on capital employed. Now, for a company or for a stock to really turn into a multi-bagger, it has to post high growth, right? If it's not posting high growth, how can it become a multi-bagger? So it has to show high growth without compromising on its ROCE, which is return on capital employed. So if you just look at this table on the screen, you will look at the list of those multi-baggers and the numbers, and these numbers as of April 2022, right? So for example, if you see Tata Elxsi, the average ROCE is 49.3 and the 5-year CAGR is about 64.9, right? Similarly, if you see L&T, 54.5 is the 5-year CAGR and 44.1 is the ROC. So what I'm trying to say is these companies are the ones which are showing good growth, but they're also showing high ROC, which is good. The next thing is growing cash flows. Yeah. Now, when we say growing cash flows, now growing cash flows are important because the cash flows truly help us understand a company's performance. If the company doesn't have operational cash flows, you're running a business and you don't have cash to run the business, then you will have to keep raising money either through debt or through equity. Now, if you're going to keep raising funds through debt or through equity, then the stock price is going to become stagnant at some point in time. Correct? So which is why you look at growing cash flows. Internally, the cash flows has to be on the higher side for you to manage your operations effectively on a day-to-day basis. I've always believed this, if in the short term, a company cannot manage its expenses, you can have the best of everything. You may have the best business plan. You may have the best growth potential. But if you don't have the potential to run your business in the short term, how are you going to manage your business in the long term? Yeah. If you're not going to survive in the short term, then there's no question of long term, which is why having strong operational cash flows is extremely important. Okay. So some stocks, it's possible that they have high ROCE, which is return on capital employed, but they don't show very good growth on their cash flows, right? So for example, Colgate-Palmolive, right? Its 5-year free cash flow CAGR is about 12.3%, but an average ROC is 98%. So the ROC is very high, which is good. But the 5-year free cash flow is very low, which is just about 12.3. Swaraj Engines, it has a negative cash flow of minus 7.6%, but an ROCE of 48%, right? So what we need to look for is, just because the company has high ROCE, which means it is giving us good returns on the capital employed, but if it doesn't have free cash flows, then it could be a challenge, okay? And then, of course, we need to analyze the sales, revenue, profits, and the stability over time. Right? You have to look at stability over time. If you don't see stability in all these important numbers like sales, revenue, profits, then then that's probably a company you should be a little apprehensive about. Okay. Now, the next thing that I want to talk about is not just quantitative. A lot of us only look for quantitative. Qualitative is so much more important. We don't give so much preference to qualitative, and I truly believe that if qualitative analysis, my company fails, then quantitative makes no sense to me, because qualitative gives me those aspects about the business which is going to help the business grow. Yes, so I'm going to use a lot of examples to show you qualitative part. Okay, so we'll start with growing industry. Now, it is very important for us to understand that the industry will have an impact on a stock, because if the industry is growing, right, then what will happen is that even the company is going to grow along with that. So, generally the sectors that all these multibaggers come from, they generally show very high growth rate. Okay, and this growth rate is sustainable for decades. In the 90s, in the late 90s, early 2000s, the IT boom that we spoke about, right? We have so many multibaggers from that time and that era, because the industry was growing like crazy, right? And because the industry was growing like crazy, we have multibaggers likes of Infosys and Wipro, because they belong to a sector which was growing tremendously at that point in time. So let me give you an example, right? So Hero MotoCorp as a company, it came up with bikes when the market segment was mainly ruled by government licenses. I'm sure a lot of you might remember your parents talking about how it was so difficult to buy a bike in those days. Just to buy a scooter for yourself, it would take you months together, and there was a black market and whatnot, right? Then we had Hero MotoCorp, which came up with the bike segment. Now, this was the industry which was migrating from scooters to motorbikes, right? And that is why this company grew at double digits, because of the middle-aged youth rising. That was the time when it was growing and people wanted to ride bikes. And that is why Hero MotoCorp has been on a growing tangent for the last 33 years because of that. Yes. So they belong to a segment or an industry which was growing, and that really gave push to this particular segment, and Hero MotoCorp did not lose out on the opportunity. Okay. Next is, how efficient is the management team? It's very, very important for us to understand that. So guys, like I said, this session is going to be in English. We've done sessions in the past in Hindi, so we keep changing language so that we are able to cater to all the audience. So this session is going to be in Hindi, in English. So I request all of you to please stop posting comments about the language. This is going to be in English. Next week our session will be in Hindi. Okay. So let's understand how we talk about the management team. So I truly believe that it's a management team which drives growth and the allocation of capital. So for example, if you see IT giants like TCS and say, financial services major like HDFC, they are rated as Asia's top few best managed companies. So from a management team point of view, they have got this rating as per, Finance Asia's 2020 survey. And these are ranked in the region. They are some of the top corporations from that point of view. So if you just look at this survey, you're able to understand the management team quality, right? And how efficiently the management team is driving the growth of these companies. Okay. Next, which is extremely important, is business model of the company. And I'm going to explain this in a little more detail using Asian Paints example, right? Now, when we're talking about the business model, I'm sure all of you agree, if the business model is not good, then there is no point investing in that business, right? If business model can, a business model would define the growth of a company in times to come. You guys, I'm sure you guys agree with me on this. Yes, a strong, robust business model has the potential to really, take the stocks to unimaginable levels. So I'm going to give you Asian Paints example, and I'm going to talk a little bit about the Asian Paints story, right? For you to understand the business model and how it can change the industry in itself. So till 1960s, paint was just like any other FMCG product, right? So from the factory, it'll go to the wholesaler, from the wholesaler to the distributor, from the distributor to the dealer, and then it'll go to the end user, the retail customer. But in the 1960s, Mr. Champaklal Choksi, who's basically one of the main founders and promoters of Asian Paints, he literally changed the business model. And he just eradicated this whole wholesaler distributors business, right? He said that I will go directly to the dealers. So he built a remarkable distribution network of 50,000 dealers whose stocks were replenished, or replenished very, very frequently. So if you look at HUL, Hindustan Unilever Limited, India's largest FMCG, it has 7,000 distributors and they replenish the stocks once a week. So for these 7,000 distributors, HUL replenishes the stocks once a week. Asian Paint delivers to 50,000 dealers. They have 50,000 dealers across India. They deliver or replenish their stocks 4 times a day. That is what Asian Paints does. It's because of their tremendous and amazing logistical backbone plus the proprietary data that they have. So I think the biggest advantage Asian Paints has is that 50 years of proprietary data of paint demand. So basically, Asian Paint exactly knows the demand of what kind of paint in which neighborhood. And that is how they deliver the paint 4 times a day to 50,000 dealers. So what happens is they were one of the first companies to invest in a mainframe computer in the 1970s. First Indian company to invest in that kind of an asset, which was obviously super expensive in those days, right? And with that, they're able to accurately predict the demand, accurately predict, what kind of paint in which locality do they need to deliver. Their prediction mechanism is much better than Amazon, by the way. So, which is the business model. So they use their data so effectively that they are able to change the business model and, of course, reach the mark where they are today. Yeah. The next thing, so this is how business models can literally change the paradigm of a particular company. The next thing is scalability, right? Now, what is scalability? Scalability and sustainability are very, very critical, not just for any company, but if you look at the industry as a whole, it is extremely important. So, like many IT companies, irrespective of their size, they became multibaggers simply because of the tremendous business opportunities that the industry provided, right? So we just spoke about that, right? Infivipro, for example. There were just so much business opportunities that these companies were able to scale up in no time. And that scalability is what is going to help us in really becoming the next multi-bagger. So a very good example is HDFC Bank, which is an 800 bagger stock. Okay, it has a history of 26 years and a CAGR of 30%. Aditya Puri, when he was hired by Deepak Parekh in 1994, he saw that the banking IT system really evolved, and in the 90s, the core banking solution, it really was evolving. And across the bank's network, he started building CASA. CASA is current account and savings account, because he realized that if you build on CASA, where you can access funds at very low cost, at 4%, and your lending is at 8 to 9%. So which means the net interest margin is suddenly very, very high, right? And what they did was they opened a branch every 2 kilometers. So HDFC Bank opened a branch every 2 kilometers, and the focus was corporate current accounts and very rich individual savings accounts. So their focus on CASA literally transformed their business into an 800 bagger stock today. Okay. So look for those scalable, look for those companies which are scalable, because scalability is going to make a lot of difference. Next is something called as economic moat. Now, what is a moat? So this is basically competitive advantage of a company. Okay, now this is a term, economic moat, which is coined by Warren Buffett, right? And moat basically tells us a sustainable competitive advantage of a company, and multi-baggers clearly are different and they stand out because they have an economic moat. So moat as a term really came in from the medieval times, right? So when the castles were built, they would have like this huge trench or, a moat around the castles, Now that was obviously filled with water which would act like a barrier and as a protection. So basically, look for the multi-baggers are those companies which have really, they have made their business model so strong that it is very difficult for their competitor to break that business model or to enter their space to that extent. So these are businesses which are scalable, which are sustainable, which have an amazing competitive advantage, because of which it becomes very difficult for the competition to come even near them. Okay. Now, in several ways, so moat can be created in multiple ways, right? So your competitive advantage could be because of, say, certain intangible assets that you have. Maybe you have certain cost advantages. Maybe you have a beautiful brand value. Maybe it's your quality of your product. It could just be anything. I mean, a company can build a competitive advantage around any of these aspects, right? So let's understand moat using an example of Nestle India. All of us have heard of Nestle India. Now, when it comes to searching for companies with this strong competitive advantage, what are some of the biggest pointers that we look for? We look for, say, financials, right? How is it that they're able to build that for themselves? So if you just look at the free cash flows, okay? So like I said, remember when we were talking about free cash flows, I said free cash flows are extremely important because they help in managing the internal funds and operational efficiency. So if you look at the free cash flows for Nestle India, okay? As you can see, it is pretty healthy here. In 2020, 1540 crores. Yes? Now, if you look at ROCE, like I had said, a good ROCE is what is going to differentiate you. Yes? So if you look at this particular aspect, return on capital employed, it measures the efficiency of growth. A 5-year ROCE for Nestle is anything above 15% is good. Okay, so when you're looking at ROCE, a 5-year ROCE of more than 15% is considered to be good. It's a good point of a strong efficiency. In case of Nestle, it is 147% for 1 year and 104% for 5 years, which is a very high ROCE if you come to look at it. Then look at their ROE, which is return on equity, right? So when we look at ROE, it basically measures that compared to the peer, what kind of profits are you making better profits from, compared to the peers. The ROE of Nestle India has constantly been rising. Okay, their 5-year ROE is at 72.51%, which is huge. And then, of course, you look at operating margin. Now, this tells you about the operational efficiency of the company. And for Nestle, for the current financial year, their operating margin is about 25%, 24.39%. Right? So these are, good numbers. So they have created their competitive advantage in such a way that has a huge impact on their numbers. Okay. So like I said, operating margin, then we look at the PE ratio. So for example, now when we look at PE ratio, after thorough analysis, if you find that a company is promising to be a multi-bagger, then obviously you look at companies with PE ratios, right? High PE as compared to the industry average, it basically means that the market is willing to pay a premium to buy that company's, to buy that company or to basically enjoy that economic moat which the company has created. So market is going to pay a premium for it. The PE for Nestle is 77.56, and a high PE sometimes could also result as structural changes in the organization. So for example, in 2008, Havells India, right? All of us know Havells India. They acquired Sylvania. Okay, it's an MNC which was much bigger than Havells, but it was under huge operational losses. Okay, in 2015, Havells decided to sell 80% of the stake in Sylvania, and because of that, their PE shot up from 15x to 35x. Right? So PE could also be impacted because of some structural changes that you're making and not because of some other reasons, right? So that's why I said that when you're looking out for PE, you have to look out for those companies and you have to look out the reason for why the PE is going up or going down. What is the reason that the company is charging that kind of premium, right? So you have to understand that, which is very, very important. Yeah? Okay. So now let's understand, when we talk about valuation, which is the fourth aspect. So like I said, if you're convinced about everything else, you are convinced about the quantitative aspects, you are convinced about the qualitative aspects, then you look at valuation. Now, when you're analyzing valuation, I'm not going to talk about valuation in detail. I'm just going to talk about the different models which are employed to calculate the valuation. So we have the discounted cash flow model and we have the dividend discount model. So what is a discounted cash flow model? It is very simple. It's used to arrive at the fair market value of the stock. So if you think that if you are paying of the fair value of the stock, then it is good for you, right? So basically how it is done is you discount the expected future cash flows of the company. So basically this is a simple discounted cash flow method, right? So you're going to just discount the future expected cash flows of the company to come up with the current valuation. Then you have the dividend discount model. Now, this is a quantitative method which tells us the true value of a stock based on the theory that its present day worth, so whatever it's worth today, is the sum of all the future dividend payments when discounted back to its present value. So basically, you take the present day value and you say that, okay, whatever the future dividends with the company is expected to pay, you sum it all up and you discount it back to the current price. Now, once you arrive at the fair value by using any of these methods, right? So either you use discounted cash flow or the dividend discount model, you need to check if the stock is trading at a sufficient discount. So whatever number you get is the intrinsic value. So ideally, the stock should be trading at a discount to the intrinsic value. And valuation methods will truly help us in giving us the right number. So we'll be able to identify if the company is fairly valued or it is overvalued or it is undervalued. Either ways, but we're going to be able to understand that through valuation. Okay, so that is what I want to tell you about the valuation aspect. Now, just to conclude, guys, I want to tell you that the most important part of a multi-bagger stock is extended consistent growth. Yes, like I said in the beginning, if you see that the stock is growing consistently over time, and you think that it has the potential to give great returns, then you have to understand to remain invested for long term, because these multi-baggers are on their own growth trajectory, right? And you don't want to miss out on that opportunity or be a part of that growth trajectory by not staying invested. So the idea is very simple. Once you have identified that golden horse for yourself, right, it is about time in the market instead of timing the market. So the amount of time you spend in the market is going to help you in getting those multi-bagger returns. So, I understand that it's difficult to identify. It's not very easy to identify such stocks, but it's definitely doable. But once you find such stocks, you can easily just sit back and enjoy the benefits of that particular company that you invested in. All of us know, right? Rome was not built in a day. Similarly, a multi-bagger company is not going to materialize overnight. You have to give it enough time. So think of the growth of a multi-bagger like that of a bamboo tree. When you look at a bamboo tree, right, the first 5 years, the focus is truly to build strong roots, right? Strong enough to handle the skyrocketing height that the bamboo tree touches. Yes, I'm sure all of you know that bamboo tree can go as high as 100 meters. But that's only possible because the bamboo tree spends almost 5 years just to build those strong roots. The aim is obviously to reach, in the future, there should be the tree should be able to grow to that height. After 5 years, within a span of 6 months, the tree grows to 100 meters. And that's because the root was really strong. And that is what you look at in the companies as well. So, you might have a portfolio of, say, 15, 20 stocks that you've picked for yourself. Obviously, all of them may not become multi-baggers in the long run. But out of your 15, 20 stocks, even if 3 or 4 companies turn out to be multi-baggers, I think the purpose is solved, right? So obviously, don't feel bad if you've missed out on few multi-baggers in the past, because if you're able to find and hold one multi-bagger stock in your portfolio, your overall returns are going to be, much better. Yeah. So great. So yes. So with that, I would like to end my session and open to questions now. So if you guys have any questions, quickly mention them, and I'll be more than happy to answer those questions for you. Okay. Okay. The first question is, how much should be the EPS value? Okay. So EPS, which basically stands for earnings per share. See, there's no right or correct EPS value. It's a relative number. All these numbers are generally relative. So basically, looking at absolute number is, if you just look at an absolute number, it may not make much sense. It may not really add much value, because if you're looking at these numbers, right, a standalone number is irrelevant. It tells you nothing. You have to compare the number either with the past years, or you have to compare the number with the industry, with the peers. Okay. So from stock investing point of view, if you're looking at EPS, it is used for what? It is along with the current market price of the stock. We are referring to the PE ratio. That's how you calculate the PE ratio. So it is in relationship between the market price and earnings per share that gives us the idea whether stock is expensive or it is cheaper. Okay, so earnings per share is a very, very relative number that we look at. Okay, someone's asking, can you please make a video on options? Okay, so with respect to options, we have done a masterclass in the month of April. You can refer to that video on the Groww YouTube channel. You'll find the video on options as well. Okay. Many of you are asking views on individual stocks, guys. So please understand that we don't recommend or advise any individual stocks because even the companies that we have considered in our presentation should be treated only as an example, right? We're just trying to explain those different theories or different concepts that I'm trying to explain using those examples. So please don't take any of them as a recommendation because we truly don't recommend or advise on any product. Okay. Okay, so let's look at the other questions that you guys have. Just give me a moment. Okay, does Groww app have a screener? As of now, Groww platform doesn't offer the screener function. So if you're looking for a screener at this point, it's not there, but it may come in the future. So yeah. Okay, just give me a moment, guys. So again, if you guys are going to ask me about, different stocks recommendations, it'll be very difficult. So how to identify multi-baggers in its nascent stage of growth? So that's going to be a stock which is probably in the mid cap or the small cap space, right? So you have to look for all these. Already explain how to identify the multi-baggers, but then ideally, if they're in the really initial stages of their business, they are mostly going to be in the mid cap or in the small cap segment. So those are the segments that you should be screening your stocks first. Okay, and once you've screened your stocks in the mid cap and the small cap segment, you've identified the 15-20 stocks for yourself, then you will be able to you'll be able to then do your complete analysis based on the based on the session that you can refer to it, and you'll be able to identify. I would say it's not easy to identify multi-baggers, but to a large extent you will be able to identify those right stocks for yourself. Okay, how to, just a minute. Okay, does stock split and bonus issue impact EPS? Yes, as the number of shares increases, EPS also changes, right? So it's obvious that EPS basically stands for earnings per share. So if the number of shares are increasing because of the stock split, your EPS also changes accordingly. So it will have an impact on EPS. Okay. How about micro cap? So see, micro caps, when you're looking at, they are, I would say, stick to mid cap and the small cap space. Micro caps are very, 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 very nascent stage. You may not get a fair idea about that particular stock if it is in the micro cap space in terms of whether it will eventually reach a strong segment or whether it will be able to touch a multi-bagger mark. So I would say not micro caps, but mid cap and small caps are the segments that you can look for. Which are sectors that you recommend? See, Abhijit, you have to understand the sectors keep changing, right? Ideally, we look for diversifying our portfolio. Yes. Now, multi-baggers can come from any segment. It's not necessary that only if you invest in this particular sector, we will have multi-cap, multi-bagger stocks. Ideally, look for evolving or those segments which are in the growing stage, or those segments which have potential to grow exponentially in the coming years. But the performance of sectors keeps changing over time. Penny stocks, see, again, when we're talking about penny stocks, it's very difficult to find, which are those penny stocks which have the potential to become multi-baggers eventually, right? Penny stocks, the risk aspect is so high that if you're actually looking at identifying your multi-baggers from the penny stock category, then your risk is going to be much higher compared to the kind of returns that you may be able to make in the long term. How much can we have to invest as beginner investors? So Ajay, I mean, in terms of amount, in terms of percentage, what exactly? When you're saying how much, obviously you start your investments, with at least 20 to 25% of your income. You should be starting as your initial investments. Ideally, take it over time. You have to increase your investment amount with time. But you can start with, say, at least 20 to 25% of your monthly income. That you should definitely be looking out for. Okay, dividend payout ratio to look upon. So generally, more than dividend payout ratio, look at dividend yield. So dividend yield is going to give you a better picture in terms of valuation compared to dividend payout ratio. So I personally look at dividend yield compared to dividend payout ratio. Whether all the discussed ratios are, is it available on the Groww? So most of them are available. We have had detailed discussions on all these ratios. If you can refer back to some of the previous masterclass, you'll be able to understand all these ratios in greater detail. Okay. Do reduction percent of promoters' value shows risk for the respective company? So, see, there's no standard answer to this, right? I mean, this is a very qualitative factor. The scenario could differ from company to company. For example, in a matured company, right? If the promoter is selling the stake and the company already has a professional management in place, then reduction in promoter stake may not have that kind of an impact. But if the company is, it doesn't have professional management, right? And if it is dependent on the promoters and you see that the promoter equity is going down, then it's an indication that, there's probably something wrong. So it depends on company to company, segment to segment. But if it is a professionally managed company, then a lower reduction in promoter stake may not have much of an impact. Okay. Okay. What else? So I'll just take one or two more questions, and then we're going to end the session. Again, if you guys are going to ask me, about specific stocks, I will not be able to give you that answer. So yes, so this video is going to be available on the Groww Academy channel, guys, because so right now we have started this whole masterclass concept on the Groww Academy channel. We used to do it on the Groww main channel. Now, because on Groww Academy, we are developing a lot of beautiful content for all of you to understand different concepts. So going forward, all the masterclass will be on the Groww Academy channel. I would request all of you to, go ahead and subscribe to the channel so that you will get access to all the content that we are creating. Okay, so primary factor in identifying. So, guys, we've discussed in detail. So I would say look at those primary numbers, especially in terms of initial screening. Those numbers are super important. And, those few aspects that we've spoken about in the masterclass. So check out the first half an hour. You'll be able to understand what are those few important aspects you should be looking at when you're looking at identifying multibaggers. Okay, how did, from beginner's portfolio, how much churn should you do? Okay, so I think more than churning, I would say review your stocks at regular intervals. I mean, it is like this general health checkup for an individual, right? I mean, consider, when you're looking at a general health checkup, you can consider selling your stocks at regular intervals. It completely depends on, consider selling only if you think that there's some serious question on the fundamentals, right? So looking at the fundamentals of a company are extremely important. When you have your stocks and you feel that there's some big problem with the fundamentals of the company, that is when you can look at removing that stock from your portfolio. There's no such thing as you should keep churning your portfolio. If you have a bunch of 5 of stocks in your portfolio which are very good fundamentally, you don't need to remove them, right? It's difficult to identify those fundamentally strong companies, and if you identified those, then ideally you should hold on to them. Is FII buying matters? Yes, it might give us a generic market trend, but you all know that over the years, the size of investments of domestic investors also has gone up considerably, right? So the impact of FIIs pulling out the money is actually come down. So impact is much lesser today. Of course, there was more dependency on FIIs earlier, but now we have so many domestic investors that impact of FIIs pulling out may not be that big. Which is the book that you're currently reading? There's this book which I'm reading, which I read quite a few times. It's called Thinking Fast and Slow by Daniel Kahneman, and that's a good book that I would recommend to all of you who are looking to, learn more about investments. So yeah, Thinking Fast and Slow is one of the books that I would recommend. Okay. So so I think with that we can end the session. Thank you so much for joining in, guys. I truly hope the session was useful. And of course, keep your questions going. We'll have the Groww team get back to you with the answers. And thank you so much for joining in today on a Sunday afternoon. And I wish you all the best with your investments and have a great weekend ahead. Take care. Bye-bye.